The biggest and most popular index fund on the Hong Kong Stock Exchange could be in trouble. It is under scrutiny by the regulator as its swinging investment policy brings uncertainties in the market. Investors are rushing to sell their stakes in the fund for fear that it may report lower performance or even lose money because of US sanctions that restrict its investments. Hong Kong's retail investors and pensioners could be the hardest hit. The Tracker Fund has an investment portfolio worth 105.3 billion Hong Kong dollars or 13.6 billion US dollars. It was created in 1999 as a way for the government to dispose of Hong Kong stocks, which were acquired the previous year to help keep the market afloat during the Asian financial crisis. The fund proved to be very popular with investors because it was cheap and easy to trade in. It was also a hit because it tracks the Hang Seng Index, the benchmark indicator of the Hong Kong stock market. Investors who bought shares in the fund's initial public offering have more than doubled their money over the past 2 decades. And many of Hong Kong's pension plans also use the Tracker Fund to make investment decisions for some of their 4.5 million members. That's why the Tracker Fund is the most widely held investment by Hong Kongers. In November 2020, an executive order by the US president banned American individuals and companies from buying new investments in firms with alleged links to China's military. The order also requires Americans to sell any existing investments in such companies by November 2021. The sanctions affect the Tracker Fund in 3 ways. First, the Tracker Fund owns stakes in 3 Chinese companies among the 35 on the US sanction list. The 3 are constituent stocks of the Hang Seng Index, which the fund tracks. Second, the fund is managed by State Street Global Advisors Asia. Because State Street's parent company is based in the US, it therefore must comply with the sanctions. And thirdly, US investors with stakes in the Tracker Fund, including hedge funds, pension funds and others, are required to sell their holdings. On January 11th, State Street Global Advisors Asia said it would not be able to buy any more stakes in the sanctioned firms. China Mobile and China Unicom were the 2 companies affected, while a third firm, CNOC, would be added in February. That effectively meant the Tracker Fund wouldn't be able to track the movements of the Hang Seng Index, and that could have potentially harmed its investors. Political leaders and market watchers strongly criticized State Street's decision, and that prompted it to make a dramatic U-turn only 2 days after it announced the suspension. State Street resumed investments into the sanctioned firms from January 14th. Although the manager has now resumed investments, the damage has been done. 2% of Tracker Fund units were redeemed as investors used the sellout as a simple way to get around the sanctions. The Hong Kong Monetary Authority, which monitors the Tracker Fund, blamed the fund manager's dramatic change of policies for creating market uncertainties, while some commentators worried the fund manager may change its policy again. They're calling to remove State Street as the fund's manager and replace it with a non-US company that doesn't have to abide by the US sanctions. Joseph Yam, who introduced the Tracker Fund in 1999, told The Post, "The whole purpose of the Tracker Fund is to track the Hang Seng Index. If the manager cannot track the Hang Seng Index, then the manager is no longer fit for duty." A booklet advertising the fund says it is supervised by a 6-member committee that meets every quarter and has the power to change its manager. So that could be an option they could explore. The fund's manager can also change if 50% of unit holders vote to do so. While changing its manager would allow the Tracker Fund to keep tracking the Hang Seng Index, it would not shield investors from the impact the US sanctions have had on the affected companies' stock values. The New York Stock Exchange has already removed non-voting shares that 3 of the companies made available to US investors. On January 10th, several US investment banks decided to delist nearly 500 investment products tied to the companies from the Hong Kong Stock Exchange. And 2 days before that, index compilers removed the companies from their global benchmarks, triggering a sell-off that wiped 59.2 billion Hong Kong dollars or 7.6 billion US dollars from their market value. So, as the US and China continue to take swings at each other in this economic feud, average investors are the ones who could feel the brunt of the blows.